All right, let's dive right in. Welcome to this explainer. Today, we are completely untangling the massive 24/7 world of foreign exchange trading. I mean, just picture this, a decentralized global arena that literally never sleeps during the trading week. With interest rates constantly shifting, sudden geopolitical events popping up, and massive investment flows changing direction, how on earth does anyone actually know what to buy or sell? Honestly, it's the ultimate financial puzzle.
And really, that brings us to the ultimate question we're looking at today. How do traders predict the future? Remember, you are navigating a highly liquid, incredibly fast-paced market where conditions can change in an absolute heartbeat. You definitely can't just guess. You need a solid framework to interpret all that noise and make informed decisions about where a currency's value is actually heading next.
To understand why predicting this market is such a huge deal, you really just have to look at the scale. $5 trillion. That is the estimated daily trading volume of the forex market. Let that sink in. It is by far the world's largest financial market. With that staggering amount of capital riding on every single market fluctuation, well, the stakes for accurate predictions literally could not be higher. So how exactly do they do it? Broadly speaking, the market is divided into two totally distinct methodologies. Think of them as the two heavyweight champions of market analysis: fundamental analysis and technical analysis. It's essentially the economist approach versus the chart reader approach. They're looking at the exact same market, but they use entirely different lenses to try and forecast where it's going to go.
Section 1. Fundamental Analysis. The Why. So the fundamental camp is entirely focused on determining the true, fair, intrinsic value of an asset. They aren't looking at squiggly lines on a screen, they are looking at the massive macroeconomic drivers that influence a whole country's economic health. Because at its core, currency prices are driven by plain old supply and demand. And who controls that? Central banks. Monetary policy, like the big decisions made by the Federal Reserve, are the ultimate engines driving currency value.
To figure this out, fundamental traders absolutely obsess over specific economic data points to gauge that supply and demand. They are constantly monitoring things like interest rate differentials, inflation rates, GDP growth, and unemployment levels, not to mention geopolitical events. And you might be wondering, why? Because capital is always looking for the best return. If one central bank raises its interest rates while another one just kind of holds steady, money naturally flows toward that higher-yielding currency, which pushes its value right up.
A classic fundamental strategy that captures this dynamic perfectly is something called the carry trade. In a carry trade, you buy a currency with a high interest rate and you simultaneously sell a currency with a low interest rate. The goal here isn't just about waiting for the price to move up or down. It's to actually pocket the difference in those interest rates over time. It is all about following that fundamental macroeconomic flow of capital.
Section 2. Technical Analysis. The When.
Now, if fundamentals are the why, technicals are the when. These are your chart readers. A pure technical analyst generally ignores the economic news and the big government reports. Instead, they rely entirely on historical price data and trading volume. The core philosophy driving these chart readers is called the efficient market hypothesis. Basically, they believe that all relevant information out there, every single jobs report, every central bank rumor, every geopolitical event, is already reflected instantly in an asset's price. So by analyzing past price movements, they believe they can spot recurring patterns and trends that tell them exactly where the price is going to go next.
To actually find these patterns, technical analysts use a very specific toolbox. They look at price charts and candlesticks to basically watch the real-time battle between buyers and sellers. They map out support and resistance levels, which are kind of like invisible floors and ceilings where prices tend to bounce. They use moving averages to smooth out all the chaotic noise and see the broader trend. And they even use oscillators, like the Relative Strength Index, or RSI. This acts almost like a car's speedometer, telling them if a currency is moving way too fast and getting overbought or oversold.
And because technical analysis can be applied to very short time frames, it opens the door to rapid-fire strategies like scalping. Now, scalping requires intense focus. These traders aren't looking for massive long-term economic shifts. Not at all. They're using technical indicators to capture tiny, minute price movements. They're jumping in and out of the market, holding positions for minutes, or sometimes literally just seconds. Another really popular technical approach is breakout trading. Remember those invisible floors and ceilings we just talked about, support and resistance? Well, eventually the pressure builds up and the price just smashes right through them. Breakout traders patiently wait for those predefined boundaries to be pierced, and the second they are, they jump in, capitalizing on that explosive momentum as the asset enters a brand new price territory. But hey,
What if the market isn't breaking out? What if it's just kind of moving sideways? Well, that's exactly where range trading comes in. Instead of looking for a big breakout, these technical traders just ride the waves. They identify a confined price channel, buying when the price hits the bottom support line and selling when it hits the top resistance line. Just back and forth.
Section 3. The Showdown. Fundamental versus Technical.
When we take a step back and objectively compare their traits, fundamental analysis is absolutely incredible for identifying long-term value and broad economic trends. But it does rely on some subjective interpretations of data, and honestly, it isn't great for day trading. Technical analysis, on the other hand, is amazing for optimizing short-term entries and exits, but critics will definitely argue that it depends heavily on lagging indicators and is super prone to interpretation bias.
Which naturally leads us to the big, tension-filled question. Which strategy is actually better? If you had to pick just one to navigate the $5 trillion daily forex market, which camp ultimately wins the title fight?
So, here is the crucial point. It's both. The absolute best traders, the ones who actually survive and thrive long-term, don't arbitrarily pick a side. They realize that fundamental and technical analysis are really just two sides of the exact same coin. Choosing one over the other is honestly like trying to drive a car with only half a windshield.
Section 4. Combining Strategies for Success. The Synthesis.
This is a truly empowering concept for anyone looking to understand financial markets. Fundamentals tell you what to trade by revealing the underlying economic truth. But technicals tell you exactly when to execute that trade to maximize your advantage. I absolutely love this analogy. Fundamentals are the climate. Technicals are the weather. Fundamental analysis acts as your map and compass, giving you the broad, overarching direction you should be heading based on the economic climate. But technical analysis, that's your local weather forecast, helping you navigate the immediate day-to-day turbulence and perfectly time your steps.
Let's see how this actually builds in practice. A trader might know, fundamentally, that a central bank just raised interest rates, which definitely should make the currency stronger. But instead of just blindly buying, they pull up a technical trading platform. They track volume trends and moving averages to verify if market sentiment actually agrees with the fundamentals before risking a single dollar of their hard-earned capital.
The logical flow of a synthesized trade looks a bit like this. Step 1. You identify the macro trend using fundamental analysis. For instance, noticing that a country's GDP is absolutely booming. Step 2. You don't jump in immediately. You wait for a technical confirmation, like a falling wedge pattern or a clean breakout above resistance. And Step 3. You execute.
But listen, regardless of whether your strategy leans fundamental, technical, or a perfect blend of both, there is one non-negotiable rule: strict risk management. As our sources clearly point out, trading without risk management is exactly like driving a car with no brakes. You absolutely must know your exit point and your stop-loss level before you ever enter a trade. It's the only way to prevent a totally emotional account crash.
We've covered a massive amount of ground today, untangling the why and the when of the financial markets. So I want to leave you with this provocative question to examine your own approach to understanding markets. Are you just reading the map, or are you just riding the waves? Because to truly master the terrain, you might just need to do both. Thanks for joining me on this explainer.